Right, I've labelled this video disclaimer and compound interest or compounding chart, purely because Forex is a very dangerous business to be involved in. So anything that is shown on these videos, my videos, and in fact any video on YouTube is for advice only. You trade at your own risk. That's got to be made very, very clear. The reason we're looking at the dollar CAD pound H1 chart rather is because yesterday I said I'd taken a trade based on the alert here, and I'd forgotten that I could actually drag and drop the trade onto the chart. So I can do that now just to confirm that really I didn't want you thinking I'd just cherry pick this chart because of a load of good looking alerts that virtually all went into profit. So let's drag and drop that onto the chart now, and there it was. Oh, that's the wrong trade. That was a trade I took at a later stage as a result of that trigger there. Now let's get the right one. Buy trade, and there's the one that's yeah, that's all right, it can stay on there. There's the one that I took as a result of the initial trigger first thing in the morning. So really, actually, that's I didn't mean to show that one, but that's a good indication. You know, if I get a trigger with the trend, with the right direction, I'll have a little go. And I had a little go down to the everything stacked up, the lower time frames and whatnot, gave me the alert, and I had to go down to the 25 level there, as you can see. Just a cheeky one, knowing that there was CAD news due at 3 o'clock. Well, it was US dollar news that was due. I think I covered that in the last video, to do with oil reserves at 3 p.m. and obviously it affects Canada because Canada is a commodity based and a strong oil based currency pair. So that's why that moves like it does. Bonkers move as well, wasn't it? You know, 75 pips from top to bottom, well, 100 pips from top to bottom actually. Anyway, I digress. So that was yesterday's early morning trade as a result of that trigger there that I was explaining away, and don't really need to go any further into that. It was just I didn't want you to think I was cherry picking the chart, as I say. Now the compounding thing once again also needs to be disclaimed, if you like, is don't get too hung up on the money you could supposedly earn trading Forex. It's a long journey and lots of people fall out, believe me. I've seen many fall by the wayside because they thought it was probably a lot easier than it would be. So it's tough, and the toughest thing is overcoming fear and greed, and that's why, as I said in the first video, you need a plan. You need just to say, right, I'm in the market for a couple of trades and then I'm out, and I'm not getting greedy and all the other stuff that people do. So I'll explain what we've got on here. It's I wrote this one myself, but you can find them online. Just look at compounding charts and whatnot. I'll try to make this one available. So principal amount is what you need in your account. Now you will hear people say never trade more than 1% of your account, or never risk more than 1%. So let's put 1% in there. And as you can see, this is telling you what you should put on. It's very vague figures because each currency pair has a different value per pip. So I've just put an arbitrary value of £6.50 a pip in here. So and that's it. You don't really need to explain anymore. So the rest is self-explanatory. It tells you how much to trade, and it does grow with the value of your account size. As I say, don't bother about the £100. You need a high leverage account, of course, 500, 400 to 1, but that's what it's there for. It's allowing you to use the bank's money or the broker's money to make your money, as it were. So, you know, why would I want to risk £1,000 with a broker that could close my account, that could spike me out? You know, because MetaTrade is horrendous for being manipulated, and it's a very dangerous business putting money with these brokers. You know, I mean, you can do your own research. I'm not even going to suggest a broker that you should use, But instead of risking 1% of 1,000, just put, for example, £100 in your broker's account and risk 10%, and you'll see that the figures add up to the exact same thing. £5.92 profit if I'm aiming for 10 pips. If I want to go for 7 pips, it's £3.38. Change that to 1,000 again and put 1% in here, and it's £3.38. So that's the little lesson on compounding. Let's suppose, because using a small amount of money and making such a small amount of money will cause you to take other risks. It will cause you to go for too many pips, or it might cause you to overtrade 4 or 5 trades a day or something. Now, obviously you trade within your own comfort zone, but all I'm suggesting is that my comfort zone is to get in, get out with a nice little lump and be done with it. Now, let's just say for example, we put £500 in our account. You might have 50 grand that you want to play with or something, so the numbers all, you just divide them accordingly. Now let's suppose I had £5,000 that the wife was going to let me to use, and let's suppose I was going to risk 3% because I wanted to grow the account. So by timesing them by 10, you can use, or dividing by 10, whichever, you can use 530% risk. So you're risking virtually a third of your account there. It's telling you what you need to put on to trade with that risk. That's just an arbitrary figure there telling me what each per pip value of this figure is. I just threw that in there just for, you don't need it at all, to be honest with you. This, let's just say I want to go for 8 pips every trade. Sometimes I'll get 14, 15 pips because I've entered straight on the 25 increment, and I've got a clear 25 or clear 100 or whatever to the next to the next support and resistance, supply and demand. So this does tend to grow a lot faster than shown on here, and over out of screen we've got the actual amounts. So you've got this all under control now. You understand this. I suggest you put one together yourself. I'll work out a way of getting it up online. Haven't worked out whether I can load this to YouTube or what to do, but I'll do that at some stage if it's requested of me. So here's how your balance grows. You've got your net gain, you've got your balance. So after a week, 1 trade a day, just going for a measly 8 pips a day, you're into, you virtually doubled your account. And then because you just keep compounding, so you can see you could take your 500 quid initial start, and then you're trading with the broker's money. Simple as that. And then the world is your lobster, as they say. So then after week 2, 5 more days, just steady eddy trading, 1 trade a day, careful does it. You're up to 1,651. So you've got 1,100 quid of the broker's money out there. And 3,000, and by week 4 you've week 1, week 2, week 3, week 4, you're actually into 10 times your original starting. Now, you will find it a lot more difficult trading these bigger numbers, but 4 weeks from 500 to 5,500 virtually is not bad going. And remember, it's just 8 pips a trade. We could get silly and go for half of one of those my 25 pip increments on my chart, and all of a sudden 500 quid starts going up. It's up to £30,000 after a month. So steady eddy. The whole point of this video showing you this is that you do not need to risk thousands of your own money. Remember, you're into the broker's money once you break that £500. You are not. You don't have to go for 30, 40, 50 pips a day. Just 5 pips a day will get you in from 500 to 1,340, so £846 profit by the end of week 4. So you can bank your own money and trade with the broker's money. Just saying, that's all. and that's just 5 pips there. Obviously you've got I've put an arbitrary 3 pip spread in here. Euro dollar is 1 pip spread, Japanese yen pound is something like 5 pip spread on average. So there you are, that's it. Disclaimer, everything you do is at your own risk, not mine, and compounding. And thank you for watching.